Imagine waking up one morning and discovering that a company worth $32 billion had vanished almost overnight. Thousands of investors had lost everything. Celebrities who promoted it suddenly disappeared. Governments launched investigations. Regulators scrambled to understand what had happened. And at the center of it all was a young billionaire with messy hair, cargo shorts, and a reputation as the genius who would save the cryptocurrency industry. His name was Sam Bankman-Fried, but the company he built, FTX, wasn't the financial revolution people believed it was. It was one of the biggest corporate frauds in modern history. To understand how this happened, we need to go back to 2017. Cryptocurrency was still relatively new, but interest was growing rapidly. Bitcoin had experienced its first massive bull run, and investors around the world were searching for the next big opportunity. It was during this period that Sam Bankman-Fried, often called SBF, left his job as a quantitative trader at Jane Street Capital and founded a trading firm called Alameda Research. Alameda specialized in cryptocurrency arbitrage, buying digital assets where they were cheap and selling them where prices were higher. At the time, crypto markets were inefficient, and these price differences allowed Alameda to generate millions of dollars. Sam quickly developed a reputation as one of the smartest traders in the industry, but he had bigger ambitions. In 2019, he launched FTX, a cryptocurrency exchange designed for professional traders. It would soon become one of the fastest-growing companies in financial history. The timing could not have been better. The crypto market entered an unprecedented boom. Bitcoin reached new all-time highs. Ethereum exploded in value. Venture capital firms poured billions into crypto startups. Retail investors flooded into the market, afraid of missing the next financial revolution. FTX grew at breathtaking speed. Within just 3 years, it became one of the largest cryptocurrency exchanges in the world. But what truly separated FTX from its competitors wasn't only technology, it was trust. Sam carefully crafted the image of an unconventional genius. Unlike most billionaires, he drove an ordinary car, slept on beanbags in the office, wore wrinkled t-shirts and cargo shorts, and claimed he cared little about money. Instead, he promoted the philosophy of effective altruism, saying his mission was to earn billions only so he could donate them to improve humanity. The media embraced him. Magazine covers called him the next Warren Buffett. Politicians welcomed him into Washington. Regulators consulted him about crypto legislation. Investors couldn't get enough of him. Meanwhile, FTX signed massive sponsorship deals. It bought the naming rights to the Miami Heat arena. It partnered with Major League Baseball. Formula One teams displayed its logo. Tom Brady, Gisele Bündchen, Stephen Curry, and even Larry David publicly endorsed the company. By early 2022, investors valued FTX at an astonishing $32 billion. To the outside world, it looked unstoppable. Almost nobody questioned what was happening behind the scenes. Behind the glamorous image, however, the company operated very differently than people imagined. FTX and Alameda Research were officially separate businesses. FTX was supposed to safeguard customer assets, while Alameda was simply another trading firm. But in reality, the line between the two companies barely existed. Large amounts of customer deposits made on FTX were secretly transferred to Alameda. Instead of sitting safely inside the exchange, billions of dollars belonging to customers were being used to fund risky cryptocurrency trades, venture investments, and speculative bets. As long as crypto prices kept rising, nobody noticed. The profits generated during the bull market masked the growing financial hole. Alameda continued borrowing more. FTX continued attracting new customers. Investors continued believing everything was fine. But the system depended on one dangerous assumption: cryptocurrency prices would never experience a prolonged collapse. That assumption proved catastrophically wrong. Throughout 2022, inflation surged worldwide. Central banks raised interest rates. Financial markets declined sharply. The crypto industry entered one of the worst crashes in its history. Bitcoin fell dramatically. Other cryptocurrencies lost even more value. Alameda's leveraged positions began collapsing. The billions borrowed from FTX customers were no longer available. Yet the public remained completely unaware. Then in November 2022, everything changed with a single leaked balance sheet. The leaked financial documents published by CoinDesk revealed something deeply disturbing. Much of Alameda Research's balance sheet wasn't backed by cash. Instead, it consisted largely of FTT, a cryptocurrency token created by FTX itself. The company appeared to be using its own token as collateral for billions of dollars in loans. Confidence disappeared almost instantly. Changpeng Zhao, better known as CZ, the CEO of Binance and one of Sam's biggest rivals, announced publicly that Binance would sell all of its FTT holdings. Panic spread across the crypto market. Customers rushed to withdraw their money. Within only a few days, more than $6 billion flowed out of FTX. It became the digital equivalent of a bank run. The problem was devastating. FTX didn't actually have customers' money anymore. Much of it had already been transferred to Alameda. Withdrawals suddenly stopped. Millions of users discovered they could no longer access their savings. Sam Bankman-Fried desperately searched for investors willing to rescue the company. Binance briefly signed a letter of intent to acquire FTX, giving customers a small glimmer of hope. But after examining the company's finances, Binance immediately walked away. The hole in FTX's balance sheet was simply too large. On November 11, 2022, FTX officially filed for bankruptcy. One of the biggest financial empires in the crypto industry had collapsed in less than a week. The bankruptcy exposed a level of corporate dysfunction that stunned even experienced investigators. John J. Ray III, the restructuring expert who had previously overseen Enron's liquidation, became the new CEO. After reviewing FTX's internal operations, he made an astonishing statement. In more than 40 years of restructuring failed companies, he had never seen such a complete failure of corporate controls. Basic accounting systems barely existed. Important financial decisions were approved through emojis and messaging apps. Billions of dollars moved between related companies with almost no documentation or oversight. Investigators later alleged that customer funds had financed luxury real estate purchases, venture capital investments, political donations, and Alameda's speculative trading activities. Sam Bankman-Fried resigned as CEO, was arrested in the Bahamas, extradited to the United States, and charged with multiple counts of fraud and conspiracy. Several of his closest associates pleaded guilty and cooperated with prosecutors, revealing how the operation had functioned from the inside. The collapse of FTX wiped out billions of dollars, destroyed one of the most trusted brands in cryptocurrency, and permanently changed how governments viewed the industry. But perhaps the biggest lesson wasn't about crypto at all. It was about trust. FTX didn't collapse because blockchain technology failed. It collapsed because people stopped asking difficult questions. Investors trusted the image. The media trusted the narrative. Celebrities trusted the brand. And in the end, what looked like the future of finance turned out to be one of the biggest corporate frauds of the 21st century.